Today, we're going to try and unravel one of the biggest paradoxes in the business world right now, and it's all about Netflix. See, this isn't just another success story. It's a story about a massive billion-dollar conflict between how well the company is actually doing and what its stock price says. It's a real puzzle, and we're going to piece it together. So, to really get what's going on with Netflix, you only need to look at two numbers. They tell two completely different stories, and when you put them side by side, you get a genuine head-scratcher, a real mystery. And here it is. This is the heart of the mystery. On one hand, you have the actual business performance, a mind-boggling 5,218% growth in net income over 10 years. That is just an insane number. But then you look at the right, and financial analysts are saying the stock is overvalued by a huge 60%. How on earth can both of these things be true at the same time? Okay, to figure this out, let's start with the good stuff. Let's look at the wow factor, the undeniable proof that Netflix as a business is an absolute profitability machine. And seriously, let's be crystal clear. If you forget about the stock market for a second and just look at the company itself, Netflix is an absolute juggernaut. The numbers don't lie. First up, 44%. That's its return on equity. You can basically think of this as a report card for how well a company uses its investors' money to make pure profit. For context, anything over 20% is considered fantastic. So 44%? That is exceptional. It's a sign of a crazy efficient business. And now, look at this, 48%. That's their gross margin. And what this means is for every single dollar Netflix earns, after it pays for all its content, all the shows, all the movies, it gets to keep 48 cents as gross profit. That is an incredibly healthy number. This table really puts it all into perspective. Just look at how Netflix stacks up. Its net margin, the final bottom line profit, is 25%. That's more than double its biggest rival, Disney, and it just completely crushes everyone else. It is a cash-generating machine, plain and simple. So with numbers like that, this should be a really simple story, right? Incredible company, must be an incredible investment. Case closed. Well, hold on. It's not quite that easy. This is where we get to the other side of the story, the part that makes you go, wait, what? It's all about the price tag, the price that the market has slapped onto this incredibly successful business. And check out how blunt this conclusion is. This isn't some vague opinion. Financial models like this analysis from Alpha Spread, they just crunch the numbers and spit out a very clear verdict. The stock is way, way too expensive for what the underlying business fundamentals suggest. And one of the classic ways to measure this is something called the price-to-earnings ratio, or PE. It's pretty simple, really. It just tells you how many dollars you have to pay for just $1 of the company's profits. The higher the number, the more expensive the stock is. This chart makes it painfully obvious. Investors are shelling out almost $50 for every $1 of Netflix's profit. Now, compare that to Disney at around 18 or the whole industry average, which is down at just 10. You are paying a massive, massive premium to own a piece of Netflix. So, how do we make sense of this? What gives? Well, this brings us to the aha moment. It turns out that crazy high price isn't about how great Netflix is today. It's about a giant, high-stakes bet the market is making on what Netflix will become tomorrow. And that really is the multi-billion-dollar question, isn't it? Why are so many smart people willing to pay that much for a stock that every traditional metric says is way too expensive? What do they see that the numbers don't? Well, the answer comes from a really clever financial tool called a reverse DCF analysis. Now, instead of trying to predict the future to figure out a stock's price, it does the exact opposite. It takes today's price and works backward to tell you what kind of growth the market is already expecting. It's kind of like a way to read the market's mind. It's a pretty straightforward process, really. You take the current price, you plug it into your financial models and run them in reverse, and what it spits out is the hidden number, the exact growth rate the company needs to hit to make today's price make sense. And this is the jaw dropper. The reverse DCF reveals this number, 16 to 18%. That's the growth rate the market has already priced in. It means that for today's stock price to be justified, Netflix has to grow its free cash flow, the actual cash it has left over after paying all its bills, by that much every single year for the next 10 years. That is an incredibly high bar to clear. And that's the absolute key takeaway. When you buy Netflix stock today, you're not really paying for its amazing performance right now. You are making a huge bet that the company will execute perfectly and achieve this massive, sustained growth for a full decade. It's a bet on perfection. So naturally, this all leads to the final showdown. Can they actually pull it off? This is where you get the two big arguments, the bulls, who say yes, and the bears, who say no way. And this divides investors into two totally opposite camps. You have the bulls, the optimists, who believe that, yeah, this growth is tough, but it's totally achievable. And then you have the bears, the skeptics, who look at that 16 to 18% target and see a huge challenge with basically zero room for error. The bulls have some strong points. They'll tell you the new ad-supported plan is opening up a whole new revenue stream. The password sharing crackdown is successfully turning freeloaders into paying customers. They're moving into new high-profit areas like gaming. And of course, they have one of the most powerful brands on the entire planet. But the bears have some powerful arguments too. The competition from absolute giants like Disney and Amazon is just brutal. The whole growth story kind of assumes Netflix can just keep hiking prices without losing subscribers. They have to keep spending billions and billions on new content to get hits, which is always a gamble. And that target of 16 to 18% growth, it means there's no margin for error. Not one bad quarter, not one strategic mistake. So when you boil it all down after all the complex analysis, the entire massive valuation of Netflix really comes down to one single, very simple question. The stock market has priced Netflix as if it's going to have a nearly perfect decade of flawless execution. So the billion-dollar question for anyone looking at this company is pretty simple. Do you believe in perfect?